For more on the sell-off in the Fed, let's bring in Cantor Fitzgerald's Eric Johnston and Mike Santoli still with us. Eric, you've been bearish for a while now. I don't suppose anything changed after the Fed meeting, did it?
It has not. The Fed is right now in a very, very tough predicament. And if you think about what is going on right now, the economy is clearly slowing down. We saw today the Philly Fed new order number was one of the lowest in the last 9 years. It's only lower during the pandemic. GDP for the first half is probably going to be negative. And while that's going on, we just had the largest Fed hike since 1994. And I think right there, that sort of puts it all into perspective. And I think that there is a view, my view would be in there, which is that, the Fed is getting most aggressive at the time where it's almost too late, as inflation is now likely going to start to come down. And while they're getting aggressive, the economy is clearly rolling over. And our view has been that the economy is going to slow very rapidly. And that continues to be the situation. That's being reflected in today's market, where you're seeing the recession trade being put on. Credit spreads are at their wides. Cyclicals are getting hit hard. Companies with high leverage that would do very poorly in a recession are getting hit the hardest. So the market is today for sure putting this trade on.
How far are we? How far are we till pricing a recession, and what would happen to earnings in that scenario?
So one of the things that happens is that as things get worse with asset prices, it tends to have a self-fulfilling effect. And so if you kind of fast forward to a market that continues to move lower, credit markets start to freeze up, you can see situations where this can kind of get out of control to the downside, and you don't have any fiscal or monetary support like you've had for at least the last 12 to 15 years. And so, because there's going to be no fiscal support, Republicans are likely going to take, Congress in November, and clearly you don't have any monetary support. It's going in the opposite direction. And so, certainly going to the low 3,000s seems very reasonable to me. It's unlikely to be a straight line. We will get squeezes. We'll get announcements that people will take as bullish. But when you put it all together, we think earnings estimates, which haven't even started to come down, need to come down, and they're going to start coming down when we see second quarter earnings. And when that happens, even though people look at the multiple having contracted, we don't think it has priced in what is about to happen, because you have to remember that the 10-year yield has gone from 50 bips to 3.3%. Yes, it's really been moving down with multiple contraction with rates, not because of that estimates are going to come down, which we think they will.